Want to broaden out the conversation, though, take a more broad look at the markets and our economy. Joining us to help us do that, Anthony Saccaro, president at Providence Financial and Insurance Services. Anthony, great to have you with us. Very important day here. Some people call it the Super Bowl of finance. We've got NVIDIA's earnings finally here, and we've got a mostly green day across the board to start the morning. What are your thoughts on the market action as we go into this report after the close?
Well, Marley, thanks for having me. The economy right now is still humming along. There's no major cracks or major problems that lead us to believe that in the next 6 months or year that we're going to have anything dramatic happen when it comes to the stock market or the economy. But it is starting to slow down. GDP is projected to be in the teens, not in the teens, 1.7, 1.8, somewhere in that range. And inflation has come down quite a bit. Consumer spending is it's hovering in the same level, but ultimately the consumer is starting to crack a little bit. Savings are going down a little bit. Credit card rates are going up a little bit. And it's all about the consumer as far as where we go from here. The United States is driven by GDP. 70% of our output of our GDP is based on the consumer. And right now, the consumer is not feeling as good as they were a couple years ago. And a lot of that, Marley, gets tied back to the labor market. The labor market's softening. It used to be that there were almost 2 jobs available for each worker. So a worker could go out, get the job of their choice. They could command a raise at their current job. They could go get a new job at a higher rate. That's changed. That scenario has softened dramatically over the last couple of years. And all of that is telling us that the consumer is just not going to be spending as much, which is why GDP is down. And that leaves the Federal Reserve in a pickle, right? What are the Federal Reserve going to do in a couple of weeks as well, too? So bottom line, the economy is humming, but it is slowing down. And I think you need to be cautious. We feel like we're kind of late cycle.
A lot of points I want to touch on there, Anthony, but let's just start with inflation. You mentioned that we are starting to see some cracks, but inflation is cooling, but still above the Fed's target here. What's the stickiest component that you are watching the most closely?
Yeah, by far, the stickiest component with really no close second is going to be the labor component, the wage component of inflation. When you are talking about commodities, groceries, food, stuff like that, energy, that stuff can fluctuate up and down with inflation. Grocery stores can reduce the price of food as the price of commodities comes down, but you can't reduce the wage inflation that happened as a result of the strong labor market that we've had over the last couple of years. I own companies. I have employees that I've had to give raises to keep. We've had to hire people at higher raises or higher wages than I normally would have liked to hire them at. And I can't go back to them and say, hey, guys, the labor market is starting to soften up a little bit. So I'm going to take those wages back, those raises. It just doesn't work like that. So that is a sticky part of inflation. And that's not going anywhere.
Certainly, and we have this sort of very interesting setup here. Like, for example, we got Kava's earnings today. We got Keurig Dr. Pepper yesterday. We are seeing spending, consumers with discretionary spending at these fast casual places on very interesting flavors of soda, which was, sort of unexpected here. But then we're also starting to see some warning signs pulling up in the labor market. Then we get consumer confidence rebounding to show that there's a little bit less pessimism in terms of the labor market from the consumer perspective. But the labor market doesn't seem to be sending any signals that should be indicating that. How are you remedying the disconnect between some of the data available to us and some of the sentiment?
Well, I don't even know that there's a huge disconnect. When you go back a year and a half, 2 years, let's say, there were, I believe the number was 1.9 jobs available for every worker out there. That is a disconnect from normal, from normalcy. That's usually the labor market's not that strong. Now we're kind of in a 1-to-1 ratio. I think what's happened is everything has normalized. That's what's happened with the labor market. The strong labor market is weakened, and it's not that we're weak. It's not that we should be panicking. We're not in a red zone at this point. There's no penalty on the labor market. None of that is happening at this point. But because it is softened, it almost is being reported as a huge disconnect. It's not really a disconnect. If it was disconnected, it was disconnected before because of COVID, because of the demand, because of the retiring workers and so on. Now it's more normalized. But if you compare it to 2 years ago, it seems like there's a disconnect. So I don't think that there's any problems going forward that are major, but it is softening. And if it keeps going and the consumers keep weakening a little bit, then we could have the problem. It's something to just stay focused on.
And that softening, of course, does create some stickiness for the Fed and what that path forward looks like for this year. What is your base case, knowing that we're getting a new Fed head, that there's going to be some shakeup in who the voters could be this year?
Well, the Federal Reserve has two jobs: inflation, keep it under control, and unemployment. Unemployment's 4.3%. It's been low for a long time. That's not their concern. That was their concern previously, but not now. It's always been about inflation. Inflation target is 2%. They're getting closer to that point. They can't wait to get to 2% to then start making moves. They'd be behind the eight ball. But the question then is when, and what are they going to do? Inflation is sticky for the reasons we just talked about, and the unemployment rate is at a level that is sustainable. Not even sustainable, very good actually, 4.3. I think they can't move. I don't think there's a great possibility at all that they move here in March. They really can't move unless those two things adjust. One of the fears that is not being talked about a lot is what happens if, with these tariffs that obviously have been shot down now, but been promised to come back, what if that has a negative impact on inflation? What if inflation starts to creep up? We've seen that happen kind of quarter by quarter, even over the last year. It's been this seesaw. But if that happens, is it possible that the Federal Reserve not only holds, but maybe has to raise? No one's thinking about that scenario, but we can't rule it out. But my best guess for this year, what the Federal Reserve does, they wait at least a meeting, maybe two meetings, and maybe by the end of the year, they cut no more than 50 basis points.
Some really good context there for us, Anthony, and very good perspective. Thank you for being with us today. Anthony Saccaro, the president of Providence Financial and Insurance Services.